So thank you, and you find that there. Thank you. It's great pleasure now to continue the discussion. So on my presentation is both reflecting discussions on the previous days and today. Slide of what is the role of the board and what is the role of reporting and what is the role of due diligence and how these are matched. So some reflections. So firstly, we must always, I mean, when we have this kind of events, and we are talking about corporations, so we must always define the corporations, as we have discussed already with Line, for instance. What is a group, and so on. So what is a corporation? So firstly, a corporation is a legal person. So most of, not all, but many of the business enterprises, they are legal persons. They have been like legal persons the last 200 or 150 years. But remember that they are not only limited liability companies, they are cooperatives. And then we have also still partnerships and limited partnerships and different kind of combinations of these, as we know, for instance, in German, where we have a variety of business forms. So cooperation, I use cooperation as a general concept, and it consists of different kind of corporate forms. So firstly, there is corporations as a legal person. Then there is some kind of, we realize that a corporation is not only a separate entity, but it is so some kind of network or bunch of entities. And the second phase was that we created a group. So there is a parent, and then there are subsidiaries. So parent corporation is the nexus of a group. So it was parent and subsidiaries, and it was so sweet than when Anne was talking about mother and the daughters. Of course, this is continental. We all have mothers and daughters, but in the UK they have parent and subsidiaries. And then the third phase is that we have a value chain. And we have a lead corporation and controlling a value chain. And we have talked about value chains today. And it's not necessarily a group, but it is a value chain. But remember that there's always, because I always fascinated in the historical continuums. So like Jörn's presentation on Monday, it was really fascinating, because he was pinpointing some kind of, let's say, turning points. His idea was a turning point was caused by communication, different kind of new ways to communicate. But the same thing for me, that we must remember, this is walking hand in hand with reporting. So we have sole entrepreneurs. That is the basic corporate forms. Somebody is making business in her own name. That is for ages. We have had let's say different kind of traders and professionals, carpenters and tailors and whatever we have. So who have worked, and it is basically the entrepreneur who might then take apprentices and or then employ people. So the German model of that, you have the master and then you have the apprentice. So yeah. And then we said, okay, then it's okay, that's enough. It's not enough to work alone, then you need also buddies. So business buddies, and then you create the new phase, so partnership. And that is Roman also around those. those times, and then we have, okay, this is some kind of, we have equal partners, but the idea that all partners don't want to be equal. Somebody want to remain passive investors, so that I am just providing investments, and then there is the entrepreneur or partners. And this idea is connected with the Sharia law and usury rules. So it is forbidden to claim interest. So then instead of a loan, you have a company. Mubarah is invention in Sharia, and then the merchants of Venice, they conveniently borrowed the idea and created limited partnership. And this is Middle Ages also around. And then bigger and bigger the trade companies, that is really the first capitalist endeavor in the 16th century or around. And then the real limited liability company with legal personality and limited limited liability of the shareholders now, and that is definitely 19th century. Group idea that, okay, we can use these limited liability companies so that there is one corporation that owns all shares in other corporations, and we have a group, parent, mother, and then subsidiaries, the daughters. And that is in the end of 19th century, early 20th century. And then we have the value chain thinking. Of course, value chain thinking has been always, I mean, all the Finnicisms, they have had value chain, but definitely the talk about value chain is now 21st century thinking. And same thing here, that, okay, who is leading this, and who are those persons, humans, who are responsibility running the businesses. So what is important here? And of course, we remember yesterday and Iris, we have AI. We have always AI. We have the first AI board members, directors in the United States. Christopher Bruner, that is also a member of Sustainability Law Research Group, and another editor of the major handbook, of the Cambridge Handbook of corporate law, corporate governance and sustainability. He has written on this possibility. Okay, we use blockchain and AI and governance, but as far mostly, and I think many member states has already also they have, at least they have closed this possibility. They say that a board member must be a human. So what is important, that in businesses, humans, so there is humans' obligations towards humans. Somebody is obliging to run the business on behalf of the group. So these obligations, that I'm a human that is some kind of responsible to other humans in a business. Would it be the sole entrepreneur that is responsible for her employees, or the humans in a parent, or then in the value chain? And these obligations can be described as accountability. So accountability is the idea that I'm accountable. I'm accountable for others. And then it is a definition who the others are. But in the end of the day, they are humans. So accountability and accountancy, so they are working hand in hand. So the humans that are working for the entity or other for the entity and other humans. So there, because always the entities, they are consist of humans. Although we think that the entity is a living organism, so it is really it is not only fiction, but it is also, it's a real thing. It's so like Otto von Dierke described the organic theory. But basically they are humans as long as the AI is excluded. And then there are humans. They have duties towards it or them. They are accountable to it. And then for accountability, it is important that you have tools that help you to fulfill your duties. There are metrics, there are key performance indicators, there are data points, and in thousands of data points, like in the European Sustainability Reporting Direct standards. And both internally, as a tool of fulfilling the duties, for instance, the general partner fulfilling her duties to the limited partner or silent partner in a limited liability or in a limited partnerships, or externally in reporting how they have performed their duties, as we have talked during these days. So accountancy, so this kind of keeping records, serves accountability. And this is then, of course, how we are doing. So this is a question about how we are reporting, what we are reporting, to whom we are reporting. And then it is a question about accountability. And when we are talking about due diligence, we are, in a matter of fact, talking about accountability. And of course, hand in hand, because accountability and accountancy, they work hand in hand. So as businesses has evolved, the nature of accountancy and reporting of it, because the report is an outcome, has evolved. So when you are yourself the main addressee of your own responsibilities, you work for yourself. You are the addressee for the sole entrepreneur partners, or partners in a partnership. But the next step, you are a servant, a steward, as it has been said, or nowadays more and more when we are talking about stewardship, for others, your community, non-active partners in a business like a limited partnership, and then gradually others as your contractual parties and the public, the state and its members, stakeholders, if you want. As you know, I am very critical towards stakeholder, but the others. And then it is evolving, but then we understand that this is really important thing, because accountancy is so important a tool for accountability. So if we want to regulate, then we start from accountancy, because through accountancy we regulate the action, and so accountability. And that's the reason the report and all things report are so important. So today we talk about the tools. So my idea is to talk a bit more. We have talked quite a lot about the tools and how to use them, the accounts and for accountancy, for accountability. And then, of course, as long as we have had businesses, we have also had accountancy and accounts. The history is long. It is connected to the birth of our very civilization. First artifacts, they are basically what we have for human civilizations. They are accounts. For in the ancient Sumer, the first artifacts we have are accounts in the matter of fact. The Andes, Mesopotamia, so Sumerian cities, there you get the first. What we have, what we create first. Okay, we want to create a civilization. What we do? Bookkeeping, yes. The oldest trade in the world. But not going there. Let's speed a bit so and concentrate on businesses. So, what is business? So we must firstly think about what is business. So when we look accountancy in business, we must first think what are we accountable for. So what kind of business model we have? That's the reason why business model is so important in reporting. So is it me as a sole entrepreneur, or is it a partnership with between Eleanor and me as equals, or maybe as Eleanor as a general partners, you are the masters and I just the silent partners, just investing Eleanor's business. I'm a silent partner as usual. Or is it a more complex thing? The complexity, we see the trend of increasing complexity. So it consists of several types of partners and members, other investors, and contractual parties, the public interest, the stakeholders. and then it is more complicated, and the reason we need more and more tools for accountants. So accountancy is evolving for accountability, because accountability is more complex. And the business models, as we know nowadays, they are a continuum of historical continuum, so developed from the Middle Ages and earlier along the Silk Road, Silk Road from China to Italy, and as the Muderbach to Commenda, so the limited partnership. And so also tools for accountability and accountancy. So they are walking hand in hand. And then so this accounting is developed then as a vehicle to recognize the inputs and outputs of inputs of business models. So downstream, upstream, downstream things. So capitals are inputs, different kind of capitals. Remember, they are not only financial capital, there are different kind of capitals. Then there's business activities, the business model, and then outputs, capitals out. And these can be described as, for instance, with this model, this is something I just visualized this. This is the International Integrated Reporting Framework, nowadays run by IFRS Foundation. You see there are 6 capitals. People talk about 6 capital: financial, manufactured, intellectual, human, social, and relationships. That means the communities and what we are making business with, and natural, the last one. And then we have the business model, and then we have outputs, same thing. Is it a positive or negative so influence to the capitals? So are we decreasing or increasing natural capital or human capital or financial capital? And then the problems comes here from if we emphasize financial capital on the cost of other capitals. But what is important here, that we have the business models, business activities, so inputs, business activities, outputs, and then we have the business models that so includes governance and performance outlook, strategy and resource allocation, risks and opportunities. That is due diligence. So that is something that running. So we could stay here, but we run forward. But basically, you understand the business models, and you understand also due diligence part of that. That is the risk and opportunities. Because what is due diligence? It is risks and opportunities. And here we see that how it has evolved. So traditionally, from the Middle Ages to until the 1960s, accountability it has been more like running the internal things in a business. So members share, creditors share, those who are investing, and then of course society. The society as a fiscus, so taxes and so on. That's the reason we need accounts so that we can calculate taxable income. And then to achieve the purposes of these, we have members. So to calculate the member share, creditor share, society share, we have those things that has been discussed earlier of historical cost, prudence, conservatism. So it must not be too positive, because it is this the valuation and accounting stuff David, Vera, and Iris talked. So this our accounting for future gain. And this is reason why accounts are so important. Why double entry bookkeeping is important. So here we have Fra Luca Pacioli. This is a painting of Jacopo de Barbari. Some says that is some guy, Leonardo da Vinci, I don't know, who cares? But anyway, what is important is Fra Luca in the middle, and you see the book. You see the red book there. The red book is Summa Arithmetica. So Summa Arithmetica, Geometria, Proporzioni e Proporzionalità, printed in Venice in 1494. This is Summa I have mentioned earlier. And this is the treatise. This is, as Vera said, Fra Luca is a genius. So that Leonardo was his pupil, untalented pupil of Fra Luca. So here is the real genius. So Fra Luca. So although Fra Luca had partnerships, of course had partnerships in his mind, so entrepreneurs in his mind, his double entry bookkeeping in Summa de Arithmetica. So that created basis for accountancy until our days and for the future. So it became the standard to understand accounting and this business entity. So accountancy and business entities, and also tool for accountability for the companies of the late 16th century, and then cooperatives and other business forms. So balance sheet, income statement, and then development of generally accepted accounting principles are based on Summa de Arithmetica. And here we see that we created some kind of idea how we keep records, and this is the European accounting regime. So it is based on Fra Luca's idea. So financial accounting serving not only the board, so those who are running the business, the management and the members of a firm, but society as a whole. Idea that this is how we give the true and fair view. Credit protection, tax accounting, prudence and historical cost, they are based on to Summa de Arithmetica. And this is, of course, clear connection to that of modern corporation, legal person with limited liability. And here we see then that so when we are talking about accounting, accountancy, it has not changed. So accounts, they serve accountability. We remember here, so that you are responsible for. But what is important here? It is to whom are you accountable to? So and what are you accountable of? And this is now the development. We must concentrate on that. And so it is it the entity like Fra Luca, because Fra Luca didn't see, although being a genius, didn't see corporate groups or value, or lead companies in value chains. It evolved. The same idea was evolving from entity to group, the value chain, and also then in regulation. So from annual accounts to consolidated accounts to sustainability accounts, and then value chain accounts we have been talking now. So on European terms, if we want, we have the fourth directive. We had the fourth directive on annual accounts. We then 1978, that was basically consolidation of this historical continuum from Fra Luca. And then the new idea of groups, group accounts, the seventh directive 1983. Then they were later consolidated to the present accounting directive of 2013. Then we add, okay, this is not enough for accountability. Then we the very, very lax and flexible non-financial reporting directive added 2014, and now we have the corporate sustainability reporting directive 2022 that is emphasizing the value chain. So here we see that now we have the basic is there, and then we have the basic idea is there, what we have created, and then we just go to the details. And the question is, does this serve the purpose? Accountability, and that is the role. When we in our systems, so there is a boardish, maybe one person or several person who direct, who manage the entity. It might be one member board, or there are several members in a board. There might be several boards, but the idea is that what is board? It is that who is accountable of for, and then we did think to whom. And then are we accountable only for the investors? Are we accountable for also only the internal investors like shareholders, or all investors of capital, including the nation and communities, the six capitals. The six capitals also can describe this kind of groups who are you accountable to, including our planet. And that is, so those who are accountable of accounts. And so as formulated in the accounting directive, that is the idea, that you are accountable of accounts. Accounts becomes the vehicle for accountability. So you are responsible, you are liable that these all accounts are true, like it's put in the accounting directive. Responsibility and liability for drawing up and publishing the financial statements and the management report. Here comes the liability rule. Member states, they must ensure that the members of the administrative, management and supervisory bodies of an undertaking acting within the competencies assigned to them by national law have collective responsibility for ensuring that the following documents are drawn up and published in accordance with the requirements of this directive and blah, blah, blah. The annual final statements, the management report, and the corporate governance statement when provided separately. And here we see, this is the rule. We have been talking about liability. Yes, we are indeed, the board is liable. But it is a devilish. The system is devilish. We use the accounts as proxy. Here we see why is reporting so important, because that it forces member states to ensure that you give correct information, and if your information is misleading and that causes damage, you are liable. So I think Article 33 in accounting directive is one of the most important provisions in our European business law. And here we see, so this is implemented in various member states, and including the EEA countries. So this is something, there must be a liability provision. Is it in company law or in accounting law or whatever law? But that is the important thing, and that's of course you see here. It is very, and it says annual final statements. So the first phase, it says consolidated financial statements, but it says also a management report and the consolidated management report, and that includes in the future, according to corporate sustainability reporting directive. So it also includes the sustainability report. So here we see how we suck it to this accountability. When did I start? Quarter past. No, quarter two. Okay, I have been talking half an hour, so not so much left. So here we see what is there important. So the board, or as it said, the administrative, management and supervisory body, however you define, is responsible of correct information of the economy of the entity, business model of the entity. Remember, the already non-financial reporting directive requires description of business model and due diligence, because there's a due diligence rules. Due diligence, you must report of due diligence, so the risks and opportunities of your business model. So the picture I gave you, so that is in the directive. It is Article 19A and Article 29A of accounting directive. So the provisions on nowadays on non-financial reporting and so as amended of sustainability report. And of the company, remember, then of the group, and now of the value chain, because accounting directive go now to value chain, unlike many national legislation, and I'm afraid maybe also due diligence directive is only the supply chain, so only upstream, so this goes also downstream. And I think duty to report, so due diligence reporting and duty to report on your business models, I think that is the clue, because then you must reveal, and you have the liability rule that are in your neck. And here we see it is extremely important how we see accountability. Is it so that we take into consideration, as in financial accounting, more and more due to the international influence, investors' interests only? That is the single materiality that was discussed earlier. That is represented in the international financial and sustainable reporting standards. So the IFRS regime, or impact to others to double materiality, as it is in the CSRD and the European Sustainable Reporting Standards. And this is crucial because this is accountability, accountancy, accounts. And the question is how far this responsibility goes. We must remember that this is the first phase of responsibility. We create responsibilities with reporting those. I'm now quoting Jaakko Salminen's and Mikko Rajavuori's transnational sustainability laws and the regulation of global value chains, where they have these three phases. Reporting law that I have been talking about. Then comes due diligence laws. So then is the vigilance law and the supply chain act, and then the transparency act. And then the third phase is liability laws, what we are lacking. But definitely reporting laws and liability or reporting, that is a good start. That is a very good start. And now it's question about, okay, how we now, that is always, reporting is the base. So accountancy, that is serving accountability. Then comes accountability, so substantial due diligence laws, and then liability laws that we have discussed. So this is some kind of summary of the discussions, today and a bit earlier this week. And then question about how we create how we create this kind of liability. We have, of course, the Milieu Defense and others, and then Royal Dutch Shell, and then, as we have discussed, and then the attempt to put the board, the directors of later Shell only. So when Client Earth sued Shell, directors of Shell, and okay, it was dismissed, but it has been appealed. But definitely here we see this trend. So okay, we find doing by suing and putting the board into or then making the board liable. So here we see that attempts might fail and they might succeed. So the first was success, the second was a failure. And then comes the question about, okay, is there a room for liability laws? And then is, of course, corporate sustainability due diligence direct proposal of the civil liability in Article 22, and finally directors' duties, so-called directors' duties in Article 25. And this is why it's important here. But I think corporate sustainable reporting directive and liability in Article 36 accounting directive, it's a good start. So that means this is reporting is important. It is connected to due diligence through this. And then let's see if it's more like we go into second and third phase. But without the first phase, there's nothing. And that is a reason that we have accountancy and accountability and accounts for accountability. So I'm now done. These are the discussion points. So what is the role of the board here? So in an enterprise, so at the end of the day, what is the liability of the board? How you create the liability, and is the board the cooperation? Of course, this is the philosophical question and also practical question, theoretical question. So is the board the cooperation? So in the end of the day, so this kind of stuff, just for food of thought. Thank you.